In 2018, a client of ours bought an HMO in the East Midlands for 200k with a projected gross yield of 10.8%. But when he came to sell it 8 years later, the property was worth exactly the same. In the same time period, in the same region, a buy-to-let property we worked on, bought for 260k, grew by £150,000. The property itself was way less effort to manage and had significantly better returns. And the reason for this comes down to two main things people almost never check when they're buying an HMO. At our business Freighter, this is exactly the comparison we run before we help any clients purchase any type of property. So let me show you the numbers for both deals and then the two things that actually explain the gap in returns. First, the HMO. This was bought for 200k with a 70% loan to value, so a 30% deposit, which was £60,000 down. It was marketed at a gross yield of 10.8%, which was £21,600 as a return on this 200k property. So on the face of it, that return looks really strong, especially when you're comparing it to most buy-to-lets of 6 or 7% gross. However, this gross yield is a marketer's dream, and it's not something you should be considering as an investor looking at a HMO. This gross yield ignores the running costs of an HMO, and these costs can be significant, so you always need to include them. We're talking 15% management costs, 15% maintenance, and void periods and things like that. Because you have an HMO where you're renting the property out on a room by room basis, you're going to have more maintenance, you're going to have more turnover, and because of that, you're going to have some more void periods as well. When you actually calculate that 10.8% gross yield is more likely to be 5 to 7% net. For this particular property, that 15% management was £3,240 per year. You then have the 15% maintenance costs, which was another £3,240 taken off that gross income. And then void periods of one of the rooms sitting empty for 6 weeks throughout the year, that takes off another £900 in that HMO. Remember, that void period isn't the whole property being sat empty for 6 weeks. It's one room within that 3-room HMO. So the likelihood is one of those rooms could have been sat empty for 4 weeks, and then another room could have been sat empty for 2 weeks while they had a change of tenant and things like that. Then once you calculate in a couple £100 for remarketing the unit, that net income is closer to £14,000 than the £21,600 it was initially marketed at. To be specific, that income was actually £14,020, so that's actually a 7% net yield, which isn't horrendous for an HMO. It's still just over £112,000 over an 8-year period in which the client owned that property. Once you then calculate in your mortgage cost of 4% at 70% loan to value, that £14,020 then dropped again to just under £8,500. Again, to be specific, that's actually £8,420, which is your actual profit annually. So on paper, that £21,600 looked correct, and it was correct gross, but you have to calculate in your net figures. And the gap between those figures is where most people that are looking at HMOs actually stop digging in. If you don't calculate in your net income on an HMO, then you're missing the whole point of investing in this type of asset. The most interesting thing though is this number and this gap wasn't actually the most interesting aspect of buying this HMO, because at 7% net, this is still a workable asset. The real problem is what happened to the value, which is something that we'll come on to in a few minutes. Before that, let's look at the buy-to-let bought for £260,000 at a 75% loan to value. The gross yield for this property was 6.4% with a rental income of £1,400 a month. You have management of 10%, which is £1,680, and then maintenance at 5%, which is £840. The reason the maintenance is at 5% is because the buy-to-let was a new property, so required very minimal maintenance. And then we had a few other costs on top of that, which was minimal things, which was £200 a year. So the net income the property was making before mortgage costs was £14,080, which was a net yield of in and around 5.4%. We then minus the mortgage cost, which was a 3% rate at a 75% loan to value, which took this income or this net income down to £8,230. This meant that the yield on this property was clearly lower on a slightly more expensive property, although they put in a very similar deposit because of the 70 to 75% loan to value difference. The big difference here though was the growth in the buy-to-let compared with the HMO. The buy-to-let grew by a reasonable rate every single year, which meant by the end of year 8 it had grown by £150,000 from 260k to 410,000. To look at that annually, that was just under 6% growth per year, compounding over that 8-year period. If we then add up this rental profit with the 150k worth of growth on the property during that 8-year period, the actual returns were £215,840 over that 8-year time frame. So the return on the HMO was 112,000 compared to the 215,840 pound the buy-to-let got in that same time frame. And when you look at it, that's the same property market in the same region over the same time frame. So there's no bias there. One property didn't grow in value and the other property grew by more than half its initial purchase price. The main reason for this is residential property almost always comes back down to supply and demand. And the main reason that HMO didn't grow in as much value as the normal buy-to-let as a residential property is exactly because of that supply and demand. We at Freighter Property call this the exit trap, and it's one thing that hardly any investors that buy HMOs look at when they're purchasing a long-term HMO. The way to think of it is this. If you're an investor looking at purchasing a property and you buy a normal buy-to-let, you can sell that to the whole property market. That includes investors looking for investment properties, but also normal home buyers looking for their home. That is the broadest possible market that you can sell that property to. And to be honest, it's the reason why residential properties just continue to grow. If we don't build enough as a nation, property prices continue to increase because demand increases and we're not meeting that demand with supply of new properties in the UK market. When you compare that with a HMO, that can only be sold to a property investor that is specifically looking for that type of property, an HMO. Property investors often only take up a quarter to a third of the overall property market. And then when you reduce that property investor market to property investors that are only looking at HMOs, that market becomes smaller again. When you then look at the fact that you're probably selling this property to a savvy investor who can see that that property hasn't grown in the last 8 years, that makes it even more difficult to find a buyer. So when this investor went to sell this property just 2 years ago, it was valued based on that, not based on the wider market of normal residential properties. Because the property wasn't being bid on by the wider market and normal residential buyers, the property didn't sell for any more money than what he bought it for 8 years prior. So the wider market in the East Midlands did keep growing, but that asset type just stood still. So that's what the exit trap is. Not what the yield is, but who is actually going to buy this when the time comes to sell. How many buyers are there realistically, and how quickly will I be able to sell it when the time comes to sell this property? I've seen this time and time again with informed investors that usually know what they're doing, that then struggle to sell HMOs when they've not made as much money as they expected to with that asset type. I even worked with a colleague a few years ago who bought his home as an HMO, and because he did that, he spent 150 grand less than what the other houses were worth on his street. The difficulty with that is then he needed to go through with the palaver of then converting that property from an HMO back to a normal residential home, but he had contacts with builders who could then come in and do that, which he then spent quite a bit of money doing. So to conclude, this isn't an argument that HMOs are inherently a bad investment. For the right investor that knows what they're getting into, it can be a brilliant way to get slightly better income in the short term if you're looking for something that's going to give you an income or better income than a buy-to-let. The mistake here wasn't buying an HMO, it was buying it based on the gross figures and not calculating the exact net figure that they're likely to get every single month. On top of that, because they hadn't thought about the exit in a few years' time and they decided to sell that property to then use that cash to then buy a buy-to-let, they actually had to take an offer which was a little bit less than what they'd even paid for it, even though it was valued at the same price. So when you're looking at an investment, you need to make sure that you're calculating in who might buy the property from you as and when you choose to sell it, even if you're planning on holding this for 10, 15 or 20 years. That's exactly what we do at Freighter Property Partners whenever we're reviewing a deal. And if you're weighing up a similar decision right now, then I'll put a link to our website in the description and you can book in a free chat with me directly. But I hope you've enjoyed it and I hope it helps you when you're making a decision on what to invest in next. And I'll see you soon.